The stock market is down over the last week, giving a massive opportunity, especially to these two growth stocks we're covering in today's episode. The first one is Ulta Beauty. Now, we are going to run through each one on a high level. We'll quickly look at their historical performance. We're going to point out things that we like from this company in their income statement, their top line revenue growth, as well as their bottom line net income. And we'll also touch upon their balance sheet, why we like it, why we believe it is strong for the future. And as always, we're going to take a look at some of their underlying metrics, some very key things you need to know, not just about these companies, but also about other companies you're looking to buy, whether or not they meet these criteria. And each one, we are going to run them through the valuation model. We want to show you what our intrinsic value is, what our own acceptable buy price is, what the investor margin of safety is, and exactly how much upside Wall Street is forecasting for these two growth stocks, which have considerable upside, and we do believe you should consider these in your own portfolios. So let's jump into the first one today. It is Ulta Beauty. Now, this is one where we have one buy rating from Wall Street, however a hold from Seeking Alpha and Quant. Both of these are in fact towards their 52-week lows, as we can see. Now, over the last year, Ulta Beauty is down 21%, so it has been hammered down. However, over the last 10 years, this is a stock that is up 350%. We can see its all-time highs around $575, and its current forward PE is very cheap, 14.45, something we will discuss, with their market cap sitting around $18.3 billion. Now, in terms of what we like about this company, firstly, we want to invest in growth companies where they increase their top line at very strong rates. They reported in January 2015 $3.2 billion on their top line. Now, in their latest set of accounts, February 2024, not even that long ago, $11.2 billion. We're talking nearly 4 times growth to their top line over the last 10 years. And look at that on a graphical basis, it is moving in the right direction. Granted, we have that anomaly in January 2021 where COVID was affecting their numbers. Otherwise, over the long term, this is moving in the right direction that you do want to see from any type of growth company you invest in. We want to see the same on the bottom line. $257 million reported in January 2015, $1.29 billion reported in 2024. So in actual fact, we do see some very strong growth, more than 5 times on the bottom line. So this is a company that not only increases their top line, but as we can see graphically as well, their bottom line moves in the right direction. Again, that anomaly, that COVID era where it did impact both top line and bottom line. Otherwise, it recovered well. So this already has a very good starting point. We do like both their income as well as their revenues. Now, in terms of their balance sheet, we do want to have a quick look, as always, at the health of these companies. $539 million of cash in 2015. Now they hold a little bit more in that latest quarterly report, $767 million. And we can see over the long term, it has been fairly inconsistent. Nonetheless, they do hold a little bit more today than they did around 10 years ago. So $767 million, how does that compare to their total debt? Well, we can see they in fact had no debt in 2015. They now hold around $1.91 billion. So it has increased, and we can see, in fact, over the last few years, although it has remained fairly stable, there's no real red flag indicators based on this information, but it is a quick check we like to do, and it will also incorporate when we do look at the net debt to EBITDA metric. So in terms of the metrics that we want to point out, first one, free cash flow per share, always very important. You want to invest in companies with consistent free cash flows that do tend to increase year on year. 2.29 in 2015, 21.10 in 2024. As we can see, it has been increasing very rapidly over the last 10 years and is anticipated to increase again into 2025. So again, off to a good start. These are some very strong metrics that you do want to see in any company you're investing, not just Ulta Beauty. In terms of sales growth, well, very strong. They've had, in fact, double-digit growth every single year, bar that COVID year that we discussed, 10% in 2024. You could argue there is some slowdown that is happening over the more recent period, in fact, going from 40 down to 10 in the more recent year. Nonetheless, still looking very solid, and with management's forward guidance, this is one that maybe we can incorporate into our own margin of safety just to have some room in case their top line does start to slow down. In terms of the total sales, then we just have another format to what we saw. Again, very strong growth. Now, on top of that, they're doing share buybacks, again, returning excess cash to investor pockets. They don't pay dividends, but what they make up for in that is that they do those share buybacks, giving you more control of the company. 64.7 million in 2015, just under 50 million in 2024, something that even though it is quite small, they do consistently do year on year, so that is a big positive that you should include in your own investment analysis. Next, we look at the return on invested capital, ROIC. Now, as a bare minimum, you want to see 10% or more just to give you faith management are able to effectively allocate their capital. Very high numbers. We're talking in the 30s to 40s consistently. Last 2 years, in fact, high 30s, low 40s. Trailing 12-month basis, again, very high. This is a very attractive number for those investors who are considering adding this to their portfolio. Now, margins, two things we want to know. Firstly, ideally around 16% or more. Second, we do like to see companies that increase their top line as well as the operational efficiency. With Ulta Beauty, it has been fairly consistent, although we do see a nice increase from 2015, 13% to the 15%. Ideally, though, we would like to see this metric a little bit higher, something that we would keep an eye on or include an additional margin of safety in our final calculation. Free cash flow margin, 5% or more, which we have seen and increased over the longer term. We also see very nice consistency over the last 6 years, around the 9 to 10%. So again, very nice to note as free cash flow always an important metric to look at. Now, net debt to EBITDA, this is the earnings before interest, tax, depreciation, amortization, and these are the number of years it would take the company to pay off all of their debt net of cash on hand. Below 3 is what we want to see. And also do note here, it has been decreasing, very good sign, well below 3, 0.49 in 2024, there or thereabouts expected next year. This is a company that does have a fairly strong balance sheet, as we saw very briefly earlier. This again is a very good bonus for investors. Now, in terms of the valuation, which is very important, typically we run through 4 models on our channel. However, for Ulta Beauty, we only believe that 2 are relevant today. We won't run through each one, we'll just do the high level look. Multiple valuation, we have around $500. DCF model around 557. On average, then the intrinsic value is $527. And as always, if you do enjoy content on this channel, do smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. We then move on to margin of safety. Now, we use 10% and we execute on that on any company if we believe it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now, we see 10% if you believe that, a buy up to 474. Then we keep going to this near the current trading price. And what we can see in today's episode, it isn't at a 30% MOS level yet. At 25%, it is up to 395. So right now we see Ulta Beauty trading at a 25 to 30% margin of safety. This is a company that is increasing their top line year on year, their bottom line year on year as well. And when we look at the other metrics, ROIC, free cash flow, all looking very positive, as well as their balance sheet. So you could justify a 25% MOS level as very strong for this company. What about Wall Street? Well, they see very strong upside, 41%, their price target $537. They do consider this to be a very strong contender for an additional buy in your own portfolio. But as always, do let me know your thoughts about these 2 stocks as we do run through. But this is the first one, Ulta Beauty. 25 to 30% MOS level with 41% upside from Wall Street, who consider this a very strong buy for the portfolio. Now, before we do move on to the next stock, just to let you know, we have released our latest free weekly article. If you want to gain access to this or any others like the 20 undervalued dividend stocks to consider for the portfolio, all completely free, do click on that pinned comment below where you can sign up and start reading straight away. Also, how to find undervalued stocks for those that do want to know where exactly the websites we use on today's episode, as well as others. So the next growth stock that we do believe to be one for the portfolio, Lululemon Athletica. Now, this is one again at their 52-week low, a double buy rating with a hold from quant. Forward PE slightly higher than Ulta Beauty, around 21.41, roughly around the same as the S&P 500 right now. Market cap 38 billion, and over the last year down 12%. If you've been a shareholder over the last 10 years, 579% you would be up, and we can see quite some way away from all-time highs around $516. So in terms of their top line revenues, what do we like? What do we see? Well, around $2 billion or just under $2 billion in February 2015. we can see here 9.6 billion in January 2024. So they've increased their top line 5 times over the last 10 years. And when we look at it on a graphical basis, beautiful. We love to see that growing year on year. Already off to a positive start for Lululemon. In terms of looking at their bottom line net income, 239 million reported in February 2015, 1.55 billion in January 24. So again, we're seeing a lot of growth, not just top line, but also their bottom line there, as we can see, growing nearly 7 times. And again, on a graphical basis, the net income moving, although a little bit inconsistently, nonetheless still very rapid increases. So again, a very strong income statement. We then look at the health of this company as their balance sheet, 665 million cash February 2015, 2.2 billion in 2024, well, their latest report in fact, and we do see it has been increasing over the longer term. Now again, in singularity, it doesn't really mean anything when we compare it to their total debt numerically and directionally. Well, they had no debt, again, very similar to Ulta Beauty 10 years ago. 1.4 billion in their latest quarterly report. So if they wanted to, it wouldn't even take them 1 day to pay off all of that debt. A very strong balance sheet. Even though we note their total debt has been increasing, their cash position is far superior. So in terms of their metrics, well, as we said, free cash flow, we want to see the growth, and boy, do we see it. 1.35 in 2015, $13 in 2024, although we do want to point out it is expected to drop marginally into 2025. Sales growth, double-digit growth every single year. We love to see that. A little bit inconsistent, but nonetheless, more recent year, 19% growth to their top line is still very positive to see for any growth company. Total sales, then, we just ran through that in a different format. Like Ulta Beauty, they do share buybacks a little bit more inconsistently, not every year. Nonetheless, they have been doing those year on year, which is also nice, again, for a company that doesn't currently pay a dividend. ROIC, well, very strong. Again, very similar, interestingly, to Ulta Beauty. Very high in the high 30s, low 40s. So again, very, very attractive for investors to consider if that is a criteria before you look and analyze company. Margin, well, a lot better than Ulta Beauty, as we can see, well above 16%, increasing operational efficiency as well. Free cash flow is also looking very solid, although we do see a drop into 2023. Always nice to look at companies that have had drops to see how they've responded, and they have responded very well. Net debt to EBITDA, remember this shows the balance sheet strength, and as we looked over the last 5 years and over next year, won't even take them 1 day to pay off all of that debt net of cash on hand. Again, very high quality companies when looking at their balance sheet, as well as in fact when we did look at their income statement. Now let's jump into the valuation model. As always, you can grab a copy of this valuation model to get to your own intrinsic value as well as your own acceptable buy price of companies in your own portfolio or those on your watch list by clicking on the pinned comment below. So a 10% margin of safety makes this a buy up to $369. Then we keep going, 20% a buy up to $328, and at 30% we can see not quite there yet. Again, at 25% though, we do see a buy. So pretty similar, like Ulta Beauty, both companies 25 to 30% margin of safety. And when we take a look at this, well, Wall Street sees some significant upside, 52%, $460. As we can see, they do believe this a very strong buy, one to consider for the portfolio. 460 price target over the next year with upside of 52%. As always though, do let us know your thoughts in the comments below. Both companies looking very strong, increasing revenues, a lot of very similar trends, increasing bottom line net income at a very strong rate. Double-digit revenue growth, ROICs in the high 30s, low 40s, free cash flows increasing. But again, there are also some downsides which we have covered when we have looked at these companies individually on the channel. As always, if you enjoy the content, smash that like button, hit that subscribe and bell button, and let us know your thoughts whether or not you are buying any of these two growth stocks trading towards their 52-week lows with some very, very large upside. As always, have a great day and see you on the next one.